companies starting with securitizers. Now, any company which is specially created for this purpose, we will call it a special purpose entity. You can even call it a special purpose vehicle. And the sole purpose of this company is to buy a pool of assets, right? So it will buy a pool of assets and then it will create securities which are bond-like in nature, that they pay fixed income coupons, right? And then they will be sold to investors. The money that the investors give will be used to pay for this pool of assets. Now you might be wondering that how does it get the pool of assets if it's paying for it later? So the way it usually works is that there is a bank involved which has created this pool of assets. For example, a bank gets deposits and it gives out loans, right? Specifically, let's say in this particular example, these loans are mortgages, home loans or house mortgages. Now, usually these are for like 20-25 years depending on the country, but they're quite long in terms of number of years, and the bank doesn't want to wait around. They want to maybe give out new mortgages, so they want the money back for these mortgages instead of waiting around for them. So what they do is they sort of either directly set up this special purpose vehicle themselves, or maybe somebody else will set up the securitizer. The bank will transfer the asset, this pool of assets, with the understanding that of course the money is going to be given to the bank as soon as these assets are securitized and sold as securities to the investors. We have a special name for these type of securities. The name is asset-backed securities, because these securities are backed by these assets. In this particular case, they will be called mortgage-backed securities because that asset is mortgages. It could be other types of assets, and I will tell you about those as well. So in this particular case, what's happening, that this SPV is the securitizer, and that securitizer is buying these assets, putting them in a pool and selling them as securities, and everybody who's buying those securities is kind of getting an ownership in that pool. And the example we've discussed over here is mortgage-backed securities or mortgage pass-through securities, which means now the people who have taken the mortgages, when they're going to make the mortgage payments on their houses, they're not going to go to the bank anymore. The bank is done. The bank got the money, and that process is now closed. Now this money will go to the SPE and they will pass it on to the investors in terms of coupon payments, like a bond makes a payment, right? So that's how the process of securitizing works. And the bank is happy because now it got its money back. It doesn't have to wait 25 years to get all that cash flow back, and it can now originate maybe new loans, right? So like I was telling you that you can do this for mortgages, but you can also do it for other things. So the bank is giving car loans. It doesn't want to wait around and collect all those car loans back. So it can just transfer the ownership of those car loans to an SPE, and that special purpose entity can securitize them. The same could be done for credit card receivables or corporate loans that a bank is giving, right, to corporate companies. We can even do it for airplanes, leases, etc. Now moving on to depository institutions. Of course, the key depository institution that probably comes to mind is a commercial bank. There are special types of banks like savings and loan bank or credit unions and similar institutions, which are primarily basically banks that are taking deposits on one side and giving loans. But you have your normal commercial banks, and then you have your specialized banks like savings and loan, etc. Right, and on one side they raise money from the depositors, and on the other side they give it to borrowers, and the borrowers pay an interest on it. The bank, of course, shares part of that interest with the depositors, right? As a financial intermediary, they are linking those two, but the difference in rate is what is going to be the bank's net interest margin, right? So if they're earning, let's say 7% from the borrowers, they're probably paying like 3% to the depositors, and the difference between 7 and 3, which is 4, is the net interest margin of the bank. So what do the depositors get? Of course, the bank pays them interest, right? And they get other services like, of course, they can write checks and transfer money, pay their bills, etc. The bank, of course, uses that money. If it's not being used by the depositor, if it's idle in the account, then the bank, of course, uses it and lends it to the borrower, earns an interest on that. And of course, that interest has to be higher than what they have to pay to the depositor. Otherwise, the bank's not going to be able to make any money, right? So the way the bank makes the money is that they usually charge a higher interest rate from the borrower than they have to pay to the depositor. And this is the role of a financial intermediary, that they connect depositors with borrowers. Of course, bank does other things as well. It can help in the process of selling equity or issuing bonds. It can invest in stocks and bonds as well, but that's not the core business of a commercial bank. Now, insurance companies. So very, very useful for people and companies to transfer their risk or offset their risk to insurance companies. So for example, if I'm afraid that I might have an accident, right, maybe the chances are low, but still there is a probability that I might run into an accident, I can pay a small premium to an insurance company, right? And what they can then do is, God forbid, if I get into an accident, then they can pay me or my family, if I'm not around, a lump sum to take care of their needs and wants. Now, why is an insurance company able to do that? Because they take this premium from a lot of people, right? So whereas, I mean, the amount of money they might be taking from me might be very less. Let's say it's just $1,000, and the amount of money they're agreeing to pay my family might be huge. If this is, for example, a life insurance that we're talking about, right? There's a huge difference in the amount of money they're taking from me and the amount of money they're agreeing to give back to me. But because they're taking that small amount of money from so many people and their exposure is diversified, that not everybody is going to, meet with an accident altogether. Only one of them or few of them, a small percentage of them. So they are able to kind of diversify this risk into a huge portfolio. And every individual can then benefit from this diversification by transferring their risk to the insurance company. Right, and it's not just people, even companies can do that, and it's not just life. We can do that for many things. So the way it works is we get into a contract, or it's called an insurance policy to be specific. We get into an insurance policy between the individual person or the company and the insurance company. We pay them a premium. So when we say you make them a payment, it's actually you pay them a premium, and then against that premium, they give you a certain surety that, God forbid, if you were to pass away, or if, let's say, you're getting it for your car and your car gets into an accident, or there is some problem with your home or your business, there's a fire in the warehouse or something, or you need some medical treatment or something, there's a theft, any kind of disaster, then the insurance company might pay you a huge lump sum. Now, disaster is usually not covered. I mean, of course, you might try to get a policy for a disaster, but the insurance company might be a little bit reluctant to do that because, again, I mean, they're trying to diversify their portfolio of risk, right? They don't want all of a sudden a lot of people to come and make a huge claim. So natural disasters usually are widespread, so an insurance company might be reluctant to give that insurance, but these are very, very common insurance: life, auto, home, fire, medical, and theft. Right, so here's an example, very simple example. You have a car, you're worried that you might get into an accident, right? So you wish to insure your car against any damages. All you have to do is get into an insurance from an insurance company, pay them a premium at a predetermined periodic interval. That could be monthly, quarterly, semi-annually, or even annually. Most likely it's going to be annually, usually it is, right? And then now basically you've transferred the risk of your car to the insurance company. God forbid there is an accident, well, you don't have to worry about it because you're paying your premium, and the insurance company will take care of the damages if, God forbid, there is an accident. Next, clearinghouse. So what is a clearinghouse and why do we need it? Let's take the examples of a futures market, right? Let's say Emirates is buying oil in the future. It doesn't know who the other party is, which is short, which is obviously agreeing to sell oil in the future to Emirates. Emirates is long. They want to secure their buying of oil at $80. Now, the way they are doing this is they are going through the Chicago Mercantile Exchange. So in this particular example, Chicago Mercantile Exchange is the clearinghouse. Now, see, if oil goes up, Emirates has locked this $80 price. So they're happy. And who's going to be sad? This person is going to be sad because they sold it at 80 and now it's at 90 in the market. So this person might try to run away. Now, how does the exchange house or the clearing house in the middle, the futures exchange or the clearing house, which is Chicago Mercantile Exchange, how does it prevent the other party from running away? So how do they guarantee the contract performance and then therefore eliminate the counterparty risk is by taking a deposit from both parties, right? They'll take some money from this party, they'll take some money from this party, and we have a special name for this deposit. It's called a margin, right? It's called a margin. And when the trade is started, we call it the initial margin, And let's say that's $10 for both, right? Just to take an example, both parties put $10 on the table. Now, since this has gone to 90, let's say the contract hasn't finished yet. It's like in the middle of the life of the contract and it's gone to 90. So clearly this person's $10 is now wiped out because that's the loss he's had on the position. And Emirates obviously has got $10 added to their position. So Emirates' margin balance has gone up, whereas this short party's margin balance has gone down and their initial margin has gotten wiped out, which is a dangerous thing because if the oil price now goes to 100, this party can just run away and the Chicago Mercantile Exchange has nothing on hold for this party. So what the Chicago Mercantile Exchange is going to do is that they're not even going to wait for it to go to 90. Let's say if it is at 10, right, and this is also at 10, and then this just goes up to, let's say, $85. So this comes down to 5, this goes up to 15, and before it goes to 0, the margin on the short party, which is going in loss, Chicago Mercantile Exchange is going to give them a call, and this call is called a margin call. It's called a margin call, which is, I mean, traditionally it was a phone call to deposit or post more margin, right? Of course, we don't physically call anymore, hardly. It's all automated now. But the concept here is that the call is to the client that please deposit more money. You have to maintain the margin. Otherwise, we're just going to close the position and because there's not enough money in your account to keep it open. Now, the real question is at what dollar amount does the margin has to fall? Like in our example, it is going from $10 to $5 for the exchange or the clearing house to make that margin call. So that depends on something called the maintenance margin requirement, right? So one was the initial margin, which they started off the transaction with, and the other one is the maintenance margin. Let's say that maintenance margin is that $5, right? So once it hits that $5 balance, they're like, oh, your balance has touched the maintenance margin. Now you need to top it back up to the initial margin. Now here I've given you the initial margin in dollar terms and the maintenance margin also in dollar terms, but in reality it is a percentage of the position size, right? So it will be, so for example, if the position is $80 to start with and you had a $10 initial margin, so the percentage will be 10 over 80. And if you're getting a margin call when your amount is hitting 5 over 80, that's the maintenance margin. So again, you can calculate that in terms of a percentage, and we're going to come to the calculation shortly. Let me just take you through the other salient points and then we're going to go a little bit deeper into the calculation. So now, where does this margin sit? Well, it sits with either an escrow agent, who of course is neither party's agent. They are a sort of a central party which is not in the interest of which is not sort of biased towards any party, but they're kind of taking care of both parties' interest. So the money stays with them, and then whoever is going long, then they transfer the profits to them, and whoever is short, of course, they keep taking from their account. And then similarly, there's going to be a margin call if the party which is going in a loss is having a balance which is lesser than the maintenance margin. And we're going to get into a little bit more calculation for this initial margin and maintenance margin shortly. But before we do that, let's talk a little bit about depositories and custodians. So if I am, let's say, buying a stock, right, and my broker is, let's say, broker ABC, and I pay them my money, right? They go to the stock market, get the stock for me, and they tell me that, okay, we have the stock for you in your account with us. Now I can keep the account, I can keep the stock with the broker, The only risk is if that the broker goes bankrupt, then there's going to be a proceedings with maybe there'll be an administrator appointed, and then I'll have to wait for my assets to be given back to me. Another option for me is I can tell my broker, listen, can you just put that stock that I have in a custody provider? So even though the broker is probably safe, especially if it's regulated by a good regulator like the SEC in the US, but what would be a better thing to do is maybe put it in a proper custodian or a depository, which of course is not just a broker. They are sort of more secure. They're designed to just hold securities, which then insulate those securities from losses which might happen because of fraud or natural disaster. So it's just a safer thing to do. Right, now let's get into the calculations here. So first of all, you have to understand that the calculations will be different if you're taking a long position or a short position. So the long position is you are buying an asset, right? And you make money when the asset price goes up. Whereas short position is you are short selling an asset, right? And you make money when the asset price goes down. Now the question is, what is short selling, right? I mean, you understand what is buying an asset, but what is short selling? So let's say there is an asset. It's currently at $50 in the market. So this is the current market price. And I don't own this asset. You own this asset. And I borrow it from you. This is me. This is you, right? You own this asset. I borrow it from you. And I sell it in the market for $50 because that's the market price. And then what I'm hoping is that it falls down, right? And let's say it goes to $20, then I buy it and then I return it. So essentially what have I done here? I got $50 when I sold it. I bought it back for 20. So actually I received 50, I paid 20. So the $30 is in my pocket. Right? So this is the idea of short selling. Now the question is, why would you want to do this? Why would you let me borrow your stock? What if I borrow it, sell it for 50 and just take the 50 and run away, right? So two things. Number one, before you even let me borrow it, you're going to ask me to put some money, right? Maybe you're going to ask me to put $20. And then immediately when I sell it, you're going to ask me to give that money to you as well. Right? So you're going to have more than what you've given me. And why are you taking more? Because what if this stock goes up instead of down? So and I only gave you 50. Now to buy it back and return it to you, I actually need 70, right? And if I'm not buying it back and giving it to you, then you can buy it back yourself and give it back to yourself because you have 70. 50 of the short sale proceeds and 20 that I have given you as additional collateral. So this is basically what's going on. And let me tell you a little bit more about it. So first of all, long positions are very simple, right? You either have the asset, but you've bought it, or you've gotten into a contract to get a right to buy the asset, which would be in the case of a call option, or you have gotten into a future or a forward contract with an obligation to buy the asset, right? In the case of a call option, you don't have to buy the asset if you don't want to, it's a right. But in the case of a forward or a future, you have to buy it. Either way, you're long the asset, right? So if the asset price goes up, if there is an increase in the price of the asset, you're going to benefit. Now, either you use your own money to buy it. So let's say you buy it using 100% of your own money. So that's an unleveraged position. But if you're just paying an option premium, very little amount, and maybe that option premium is just $1 and the stock is actually worth 50, so you use just $1 to take a long exposure on a $50 asset, right? Or you got into a forward contract or a future contract with very little margin deposit. Maybe you just deposited $5 margin and you got a long exposure on a $50 contract. So the position can be leveraged as well or levered as well. What does that mean? Think about it in terms of a company, right? A company gets some owner's equity. There are shareholders who put their own money, but then they could get a bank loan and then they buy some assets to do business with that. If the assets are worth 10, the equity is 5 and the loan is 5. So they're actually being able to use the money of just 5 to buy something which is worth 10. Why they're able to do that? Because of this leverage that they're taking by borrowing money. Similarly here, we're borrowing an asset, we're buying an asset, but we're maybe either using 100% of our own money, in which case it's an unleveraged position, or we might be borrowing money and taking a leveraged position. Now that can be done through 3 ways. One way is, of course, that you get a call option. So you're paying a premium and getting a right to buy the asset. Let's say you have the right to buy the asset at 50. If the asset price goes up, you're happy because, let's say if it goes to 100, you're happy because you can buy something for $50 and sell for 100, which means you make a profit of $50. So you only invested $1 and you can make a profit of $50 on that if it goes to 100. The second thing is, let's say you got into a forward contract or a future contract to buy this asset for 50, and if you have like a forward contract, maybe you didn't have to pay anything right now. If it's a future contract, maybe you just paid a few dollars margin, let's say $5 margin, and again you got an exposure for $50 through just paying a $5 margin. But that's not the leverage position that we want to focus on right now. What we want to focus on is that if this position is for $50, right, how much money are you putting in and how much are you buying, how much are you borrowing from the broker or the bank as a loan? So we're not talking about a forward or a future contract over here. We're not talking about a call option over here. What the focus of this reading right now is, especially when it comes to the calculation, is that you're buying the asset in the spot market, right, for the full price. It's just that you're not paying for that full price yourself. Maybe $25 you're paying yourself and $25 you're borrowing from the broker or the bank. Now that's basically what's going on. And how much you can borrow is going to depend on something which is called the initial margin, that this is the amount of money you have to put down, right? So let's say if the initial margin is 50%, so 50% of $50 is $25, which means the remaining 50% you can get as a loan. The second thing which we're going to look at is, what if the stock starts to go down? If the stock starts to go down, then the loan is not going to change. Let's say if this goes to 40, the loan is not going to change. Your money is going to reduce. So this $10 will actually be a loss for you, and this will go to 15, right? Which then brings me to the second point, that what is the maintenance margin? And let's say the maintenance margin is 40%. So at any given point in time, you need to have 40% of the investment value, right? And if your remaining balance is less than that, then at that point you're going to get a margin call. Now I'm just going to explain to you how to calculate that price, how much it has to fall for you to receive that margin call. But before I do that, let me just talk a little bit about short positions, right? So like I was telling you, that if I am borrowing an asset from you and it's at $50 at that point, so I borrow the asset, I sell it, right? I sell it in the market and I get this $50. Now what I'm hoping for is that it goes down. Let's say it goes down to 40, and then I can buy it back and then return it to you. So from the perspective of a short party, I would benefit if the price were to go down. On the other hand, from the perspective of the long position, we just saw, and let me show you again, that if it was going down, we're actually losing money. So the long party makes money when the price goes up, whereas the short party makes money when the price comes down. Both these positions can be leveraged. So for example, what we just saw in the long position, and let me show you again, that just by putting down $25 on the table, because the initial margin requirement is only 50%, they were able to take a position of $50, right? Similarly, coming back to my example with you, that if I am borrowing this stock from you, of course, the $50 that I will get, I will immediately post with you as collateral. But even before that, I might have to give you something as well, right? Because you need more than 50 in case the stock goes up and you have to buy it back yourself, because I'm not buying it back. So not only will you need that 50, you will need something more than the 50 to buy it back. So you're going to take something from me before you give me that stock to borrow. Now, it might be the full price of the stock, it might be less than the stock. So my actual investment is only that $25. This $50 I'm actually getting by selling the stock. So this is not my investment, this is your stock which I'm selling and giving you the money. So my investment is the $25, which is less than the $50, which is my position size. So even the short position can be leveraged. And there are some more things in the short position that we need to be careful of, and I'll just tell you about them, right? But again, let's go through this slowly. So what are we saying? A short position is created when they sell a contract or a stock which they do not own. They borrow it, right? They borrow it and then they sell it. So they borrow the security, they sell the security in the market, and then what they're hoping is to repurchase it at a lower price and return it. Now the tricky bit is what happens if there's like dividends and stuff coming on that stock during the time which you buy it back. So let's take an example. Let's see there's a stock XYZ, and let's say there's a stock XYZ and you think that the price is going to go down. So what you do is you have this perspective that I'm going to buy it back and return it when the stock goes down. So you borrow the stock from a long party, you sell it in the market when it's trading at 50, and you get your $50. Now as per your expectation, it falls down to 40, you buy it back, you return it to the long party, and you get your $10 profit. Right now, what's the maximum you could have gotten? Right, if it went down to zero, right, you bought it back for free, you could have made a $50 profit. That's your maximum gain, which is bounded, right? But what if instead of coming down, it went up to like $1,000 or $100,000, right? I mean, if you're interested, look into something called GameStop, which some hedge fund had actually short sold, and instead of coming down, it just kept going up. So the risk with a short position is that the potential loss is unbounded. The stock can go as high as, you know, anything is possible, especially if it gets into something called a short squeeze, where it's just going up, and to return the stock, you actually have to buy it and return it, which means when you go to buy it, you push the price even higher yourself, right? That's called a short squeeze. So the problem with the short position is that the gain is bounded, but the loss is unbounded. Now, if the stock price increases instead of falling, the short seller incurs a loss as discussed, and there is no limit to that loss. Therefore, the short position is very risky. For the long position, of course, the gain is unbounded because it can go as high as it can, whereas the loss is limited because what's the worst that can happen? It can go to zero, so you can lose your original investment, but as far as the profit is concerned, there is no maximum limit to the profit for a long position. Now here is where things get a little bit tricky. So when I borrowed this stock from you, right, of course I'll have to put something with you as security before you let me borrow that stock, right? So to secure the security, I'll have to give you something, and not just that initial something, but of course the money I get from selling the stock definitely has to go to you. And what will happen is that this money which I am giving to you is going to obviously earn interest for you, right? And because you're taking this money from me, you're going to pay me a certain amount as well. So the security lender then invests the proceeds in the short term. The security lender is you who's getting this money from me, right? And you're going to earn a certain interest on it, and you're going to pay me certain interest because this is my money which you're taking, right? I know it's your stock, but I'm the one who sold it in the market and got that cash, right? I am the short seller, so it's actually my cash which I'm giving to you as collateral. So you're going to pay me a certain interest on that, but the interest you're going to pay me will be less than the interest that you're going to earn, right? So that's good for you. So you, the security lender, are giving me the stock because the rate of interest you pay me on the cash is lower than what you're going to receive on investing that cash, right? And usually, practically speaking, I'm not just going to give you this money, I'm going to give you something extra as well, right? So you're going to be earning interest on that too, which is more than what you're going to be paying me on that. So what have we discussed so far? Short position gain is limited, right? Maximum 100% of the investment. So if it goes from 50 to 0, that's the maximum I can get. But if it goes high, well, it can go to infinity. So my loss is unbounded. Whereas for you, your gain is unlimited because you're going to get the stock back, right? And it can go to infinity. But the loss for you, maximum the loss for you is you lose your $50. Right. Now, some calculations. Calculation number one, the leverage ratio. So first of all, very simple, whatever securities you're buying, right, you're putting down some money to be able to do that. Now the leverage ratio basically tells you how much amount is the value that you have taken versus how much amount you've put down. So you're trying to understand, okay, how much I've really borrowed. So what you do is you let's say if I'm taking a position of $50 and I'm only putting down $25, that means I've taken a position 2 times larger than the amount of money I have, right? So this is basically as a multiple of your equity investment. Relatively simple to calculate, right? Now the other one, which is a little complicated to calculate, is the margin call price, that how much this $50 price has to change before the party which has taken the leverage is going to get a margin call. Now what I want you to do is take a step back over here and get out of the short position mindset, because I think almost 99.9% probability is that the question that you will get is going to be for a long position. So I want you to approach this calculation from the perspective of a long position. And yes, we're definitely going to think about it as a short position as well. But once we have completely understood the concept from a long position perspective, and once we've done the calculation from a long position perspective, then we will talk about it from a short position perspective. So again, what is the long position perspective? You're buying an asset, let's say, and you're using some of your own money, right, which is your equity, and you're using some of borrowed money, which is, let's say, a loan. Now how much is your margin, right, which is you're putting down on the table, depends on something called the initial margin, right? And initial margin is going to be as a percentage of the position size, right? So you have to obviously start off with what is the position size that you're taking, what percentage of that you are required to put down on the table. That's called the initial margin. So we're going to start off with that. And the remaining amount is called the margin loan. Of course, you're going to have to pay an interest on this loan as well, and we'll come to that later. Right now, we need to focus on how much this position has to fall for you to get something called a margin call, because we're going to calculate what is the maintenance margin next, right? And we really want to know is that when the initial margin falls to a level which is now equal to the maintenance margin, that's where you're going to get a margin call, right? So whenever you buy securities on margin, you're subject to margin requirements, which starts off with the initial margin requirement, which is the minimum amount of money you need to put down on the table, which is your trader's equity. And then the next thing is your maintenance margin, right? And the price at which you're going to get a margin call is basically calculated through this formula, and this is obviously for a long position, right? This is not for a short position. Therefore, what I want you to do is think about this entire thing from a long position perspective, and we're going to solve a question next. But before we do that, let me just take you through all these points. So what's going on? The trader is borrowing money from their broker to pay for the remaining amount. Of course, the advantage here is that if the stock goes up, then the trader's return is going to be much more because they've invested a lesser amount, right? So the return on investment for them in percentage terms will be much more because they've bought the securities on margin, right? Which means they have put in a little lesser investment instead of buying the whole thing on cash. So if the stock goes up, they'll make a huge return. Leverage enhances their return, but it's a double-edged sword, right? Which means if the share price falls, then the loss will be, the return will be also enhanced towards the downside as well, which means their equity might fall very fast. And if it touches the maintenance margin, which means they're going to be hitting the margin call price, at which point they're going to receive a phone call from the broker saying that please add more money or we're going to close the position. Right? So now that minimum amount of money they need to maintain in the account is called the maintenance margin, and that's when they receive the phone call when the equity hits the maintenance margin. Now the real question for you is to be able to calculate the margin call price if you're given the price, you're given the initial margin requirement and the maintenance margin requirement. So for example, if the initial margin requirement is 25% of the position size, maintenance margin is 20% of the position size, and let's say price is $50, then what you have to do is 50 into 1 minus 0.25 divided by 1 minus 0.2, and that's how you get your margin call price. Now what I want you to do is pause the video and try to calculate, number one, the leverage ratio. And if you don't remember what the leverage ratio was, it was the position size divided by how much money you're putting in the bank, in the account yourself, right? Number one. Number two, you're starting off with a price of 50. I want you to calculate the margin call price, where you take the price you're starting off with and multiply it with 1 minus the initial margin divided by 1 minus the maintenance margin. So please pause the video, calculate both the leverage ratio and the margin call price. Right, hopefully you were able to calculate the leverage ratio, which is 50 divided by 20, and the margin call price, which is 40, because the initial margin requirement is 40%, maintenance margin is 25%. You take 50 multiplied by 1 minus 0.4 divided by 1 minus 0.25. Right, now coming to the short position. Now before you try to answer this question, what I want you to do is think about it, that if I am taking this stock from you and it's at $50, right, and I'm selling it, and then I need to return it to you, right, and let's say I've given you $20 as a margin, plus I've given you this $50 that I got. Now first of all, how much money did I give you depends on what is my initial margin requirement, right? I gave you 20 because maybe you asked me for like a 40% in initial margin requirement, and 40% of $50 is obviously 20. So that's point number one. Point number two, how do I make money? I make money when this goes down, right? But if this goes up, what will happen? Obviously, I will lose money and you're going to deduct the loss. Let's say it goes to 70. Now, you have $20 from me from before, and you have the $50 that I gave you when I sold this. You have your 70. What you're going to do is you're going to buy the stock back, and you're going to tell me the deal is off. Unless before buying the stock back, you might give me a chance. You might call me and say, hey, please deposit more money. Otherwise, I'm buying the stock back and the deal's off. And you're not even going to wait it for it to hit 70. You're probably going to start calling me when it hits 60, depending on what's the maintenance margin. But like I was telling you, this margin call price business, it's for a long position. So what I want you to do is, as far as margin call price calculation is concerned, the formula I want you to remember is this one, which is original price multiplied by 1 minus the initial margin divided by 1 minus the maintenance margin. I think there's almost a 0% chance that you might have to calculate the margin call price for a short position. But if you want to be super diligent, all you have to do is you just have to flip these two, where maintenance margin goes in the numerator and initial margin goes in the denominator, and you will be able to calculate the margin call price for the short position. But I don't think you have to do that, and I don't think that question can come into the exam for you. From a short positions perspective, what you need to know is at a conceptual level, how much initial margin has to be there. Well, it depends on the initial margin requirement and what is the original position size, right? Number two, you should have a conceptual understanding that how does this margin requirement impact you. So please pause the video, calculate how much margin you would require to take this short position of 500 shares if the stock price is 30, and also think about how the margin requirement would impact you in the case the stock goes up and the stock goes down. Then I will show you the answer. So pause the video and try to solve it, please. Right, so obviously the position size is $15,000, which is 500 shares into $30 per share, right? And which means at 40% initial margin, you need to put $6,000 on the table. Furthermore, if the stock price goes up from 30, well, they're gonna deduct that from your initial margin, and depending on whatever is the maintenance margin, then you might get a margin call. So that is one calculation that you need to know, this one, and mainly the long one, and also maybe just the calculation of the initial margin for the short. But another very, very important calculation is this, which is coming up, which has a very, very interesting adjustment that you need to do for the sales commission. Very carefully, you have to separately treat the buying commission and the selling commission. They both have to be treated separately. Anyways, I think you need a break. So what we should do is, let's take a break here, get fresh, come back, and then let's jump into this calculation.